Home ownership is one of the best ways to improve your overall financial health and to start building wealth. But not everyone has the opportunity to do that, especially now that interest rates and home prices are sky high. But there's a solution. So in this video, I'm going to walk you through the USDA Direct loan. I'm going to go over who's eligible, what the requirements are, and how you can apply. So let's jump into it. Hey, what's up guys? I'm Ben Sund. Welcome to my channel. If you've been here before, welcome back. If this is your first time, welcome for the first time. I don't just cover home ownership and mortgages. I also go over things like personal finance, investing, and real estate. So if that interests you, please hit that big red subscribe button. The USDA Direct loan is a great way for families and individuals of low to very low income to get into a home that they can afford. It's specifically designed for that purpose. It's to help low-income families or low-income individuals get into a home that they can actually afford, meaning it's designed to help you improve your financial situation through affordable home ownership. And they actually may help you with the monthly payment for a short period of time. I'll talk about that more in just a second. But first, USDA Direct means that you work directly with the USDA, not with a lender or a bank. They require 0% down, and you can have a 30-year, 33-year, or a 38-year loan term. So let's first talk about who's eligible. Keep in mind that additional information and links are in the description down below. I'm gonna try to make this as clear and succinct as possible, but there's a lot of moving parts, so you might wanna like this video so you can come back to it later if you have any questions, because I don't expect you to memorize all of this. So the basic eligibility requirements, these are gonna be for you and the home. Now keep in mind that there are going to be like credit and income requirements, but these are the basic eligibility requirements that a borrower has to meet in order to preliminarily qualify for this loan. So the basic eligibility requirements are: you must be without decent, safe, or sanitary housing. You have to be unable to obtain a loan with other resources. So like you can't go through a traditional lender. You have to agree to occupy the residence as your primary residence, meaning it can't be a second home or a rental. You have to have legal capacity to borrow in the United States. You have to meet certain citizenship and eligible non-citizen requirements. And you can't be suspended or disbarred from participating in any federal programs. And then the property has to meet, it has to generally be under 2,000 square feet. It can't have a market value in excess of the area. So it can't be worth more than most homes in the area. And then it can't be designated for income producing properties. So you can't be a rental, it can't be an Airbnb, it can't be farmland or anything like that. It has to be your primary residence, and it's got to be treated like a primary residence, meaning that you can't make it into an income producing property. And as I said, there are income and credit requirements. So let's talk about those. I'm gonna go over the income first, and then we'll talk about the credit. So as I said earlier, you have to be considered low to very low income for the area that you're looking to buy in. Now, in the description down below, there's gonna be a tool where you can plug in the area that you're looking to buy or areas that you're considering buying, and that's going to give you the income limits based on like 1, 2, 3, 4, 5 family households. And that's going to give you the income limit for your situation in that area. But before you jump over there, there's other caveats that are really important because it's not just based on those income limits. So let me talk about who qualifies for income or what income they use to qualify you for those limits. So the first caveat is they use, and this is for the income limit qualification, they use every adult that's going to be living in the household's income, and they use all income sources. So let's say, for instance, you and a spouse are applying for the loan, but you have an uncle living in the house, or an uncle that's going to be living in the house. They're going to include that uncle's income into the income limit qualifier. So you're going to want to look for the income limit of 3 adults and see if you still meet that income requirement. Now that's only for the income limit. For the income on the loan, they're just going to use you and your spouse's income to see how much payment you could qualify. And the income that they take into account are going to be jobs, unemployment, public assistance, child support and alimony, Social Security, retirement, and self-employed income. Now, there are exceptions to the every adult in the household rule, and those exceptions are going to be that it doesn't include aid or foster persons, and it doesn't include people under 18 or people over 18 that have earned income of $480,000 a year or more if they were in school. And as I said a minute ago, they take the income for everyone in the household only for the limit, but they take everyone on the loan's income for what you can qualify for. So for instance, let's say you're looking at a $200,000 house in an area that has a $40,000 income limit. The people on the loan's income would be used to qualify for the $200,000. Everyone in the house's income would be used to qualify for the under $40,000. So you kind of want to match those up, because you could find yourself in a situation where you make enough to qualify for the $200,000 payment, but you exceed the 40K income limit because there's a person that's over 18 living in your house that they're going to use for the 40K limit. I hope that was clear enough. If you have any questions about this, comment down below and let me know, and I can answer them in more detail there. Those were the basic income requirements, but they also have some pretty weird credit requirements. And they don't just look at your credit score, they also look at your ability and willingness to repay. So let's discuss what those are, because there can be kind of some moving parts here that can get confusing if you don't know what to look for. So similar to income, they're going to look at all applicants' credit scores. And if you're in a communal property state, they're going to look at your spouse's credit score as well, even if they're not on the loan. So if you have a 640 or more credit score and you don't have any judgments or federal liens, you're going to qualify for an expedited review, meaning that they're not going to ask too many more questions about your credit. That qualifies. If you have under a 640 credit score, they're going to require additional information. And the following might make you ineligible right away. And that is if you have a federal judgment excluding tax courts, you're going to be ineligible. If you have a foreclosure, a bankruptcy in the last 36 months, they're going to want extended review, but you may be ineligible. And they're going to want 3 additional trade lines with a 12-month history. So these are going to be a 12-month history of things like rent, utility bills, personal loans, car insurance, basically anything that wouldn't traditionally report on your credit report. You could provide 3 of those with a 12-month history, and that can work as alternative credit to help you qualify. There are some unacceptable credit sources that could make you ineligible for the loan as well. And those are going to be, if you have low or no credit history, you can have actually a low score that would traditionally get you turned down for a mortgage. If you have the alternative trade lines that we talked about and you're not in current poor standing with any of your creditors. But if you don't have very many trade lines and no alternative credit, or if you have no credit and no alternative credit, you could find that you're going to get denied for the loan. The other thing is you can't have a 30-day late on any installment loans in the last 12 months. An installment loan is going to be something like a car loan or a personal loan. And then you can't have 2 or more 30-day lates on a revolving credit. So that's going to be something like a credit card, something where the payment isn't guaranteed to be the same each month. If you have 2 or more 30-day lates on those in the last 12 months, you could find that you're going to be ineligible. But there are exceptions to this, and those are going to be that if your shelter costs are greatly reduced, it could override some of these other credit requirements. This is where I said that there's a lot of moving parts, and it's kind of based on your personal situation. USDA is going to do a little bit more in-depth research than maybe a traditional lender would, who's just going to go off your credit score. The exceptions are going to be that, one, if it greatly reduces your shelter costs, meaning let's say you're paying $2,000 a month in rent now, and you're going to get a home for $1,000 a month, that could override some of these credit qualifications. The other thing it's going to be is if it was a temporary situation or a temporary reason why your credit was reduced, and that's going to cover like unexpected job loss, delays in benefits, inability to work due to an injury, increased expenses due to illness, basically any issue that's temporary in nature. And then the other thing is if it's a good benefit to the government, then they might give you an exception, meaning that if your shelter costs are greatly reduced and now you can pay the government back if you owe them money, they might approve it because it's going to be a benefit to them. Now, one of the good benefits to this program that isn't offered by very many or really any other programs is they may offer you payment assistance if your income has been decreased, and they will do that for up to 2 years. Now, you do have to pay it back, but it's put at the end of the loan. So you would have to pay it back if you were to refinance or sell the property. but they may be able to offer, again, for people who have had income reductions, they may be able to offer monthly payment assistance because, again, this program is designed to help families of low income improve their situation. And if that means that they help you out make payments for a little while to where you can get back on your feet or get in a better financial position, then that's what this program's for. And because they're trying to help you get back on your feet, you may have to report any like household or income changes. Income changes would be anything over 10%. Like if your income increased again, they would remove that payment assistance because it's for people who have had decreased income over a period of time. Another cool thing about this loan is that you actually are able to refinance as your income situation improves. So, and actually USDA might actually make you refinance or make you consider refinancing once they analyze your income situation and determine that you would be better off with a traditional lender or traditional mortgage. So you're not actually stuck in this loan for the life of the loan. You can actually refinance, which is really cool. You could take advantage of lower interest rates or lower payments. And again, as your income improves, it might be worth it to look into that. And now this is a question that I've gotten before, and that is, can I rent the home? And as I said earlier, it's used for a primary residence only. It's not to be used for income producing. So no, you cannot rent the home. If you rent the home out, they can revoke your payment assistance. They can make you refinance with a different lender. It's pretty critical that you live in this house as a primary residence and you don't try to rent it out. Again, that's not for people who are trying to become landlords or build their rental empire. There are different loan programs that we can discuss to do that. But this is for, again, low income to very low income people that are trying to improve their financial situation and have stable, good housing. So I know this was exhaustive, but start by looking at the income and property tool in the description down below. And if you feel like you meet some of these basic requirements, contact USDA directly, and they're gonna walk you through exactly what you need for your situation so you can start buying a home. Again, the contact information is gonna be in the description down below. If you have any questions that weren't covered in this video or any questions that you need expounding upon, please let me know in the comments down below. And if you got value out of this video, it really helps if you hit that big red subscribe button. We'll see you on the next one.